Major averages still, though, sharply lower over the past month as the markets continue to navigate the uncertainty around tariffs and the state of global trade. So where can investors turn with all this volatility? Joining us now with his take is David Spika. He is the chief market strategist at Turtle Creek Wealth Advisors. David, bonds aren't doing what they typically do in this sort of environment. So a lot of investors probably wondering, how do you balance things out? Where do you go for relief from all of this equity volatility? What do you say?
Well, I still think that bonds offer a nice opportunity. Clearly, the spike we had in rates was a bit of a shock, but rates seem to have settled down now. Municipal bonds are very cheap today for high net worth investors. But ultimately, I think you have to look at where is the economy heading. So today, with the S&P down about 15%, if we don't have a recession, stocks look very attractive. If we do go into recession, probably have more downside. Ultimately, what we need is a win. We're like a baseball team on a losing streak. We just need a win to restore confidence in the clubhouse. And right now, confidence, whether it's businesses or consumers, is very low. They want to see some clarity on the tariff front. We get that, and I think we can avoid recession, and I think we can see the market go higher, and bonds and stocks should perform well in that environment.
Okay, you mentioned municipal bonds, which is like catnip for me. I got to admit it. I love the topic because I think it also speaks to a longer-term perspective and thinking about tax equivalent yield, particularly for those who are making a lot of money and maybe in some higher tax brackets. What are the sorts of things that investors maybe who are on the higher end of the income scale can do to think longer term beyond just the day-to-day volatility and make some smart decisions in this environment?
Well, you said it. The municipal bonds are for high net worth investors. And here at Turtle Creek, our clients are ultra high net worth. So avoiding taxes and minimizing taxes is a big part of their strategy. And municipal bonds fits well into that. Right now, we rarely see an opportunity to buy municipal bonds this cheap at this high a taxable equivalent yield. So investors need to be considering that. And again, it really depends on your own personal risk tolerance, what you're trying to achieve. If you're younger, you still want to be more invested in the equity markets. If you're a little bit older, approaching retirement, increasing that fixed income exposure, that lower risk exposure makes a lot of sense. And municipal bonds are a great way to play that right now. And again, a once in a multiple year opportunity to get in at these valuations.
See, I just think John is too young of a how can he be in munis? He's in love with munis, David. And now he's laughing all the way to the bank. I memean, I know they've underperformed in recent weeks, but if you're holding it till maturity, I guess you don't care. And you get in now, maybe you get some even better yields. But I just think he's got decades. Right? The stock market
maybe he's
will
making
do...
too much. Maybe he's making too much money, and that's why he needs the muni bonds. That could be the thing.
As a tax shield. So what is your outlook for stocks, though? I mean, broadly speaking, is it, what do we do? Where you like Netflix? You like EOG? I mean, there's some idea. Netflix makes me worried because everybody loves it here, and it's done so well. But,
right.
Maybe it's just got just the right mix of things for a difficult environment.
Well, Kelly, because there's so much uncertainty, we want to own companies with visible earnings growth that have limited to no impact from the tariffs. And I really think Netflix fits squarely into that. Look at their last quarterly report just last week when they had the gall to go out and raise guidance for earnings, revenues, and margins for the second quarter. Nobody's doing that right now. Nobody has the confidence to do that. They also reiterated full-year earnings growth of over 21%. So clearly, the metrics are very strong. And I would argue Netflix is a very defensive name right now. Who's giving up their Netflix account even if we go into recession? I don't think people are going to do that. That's going to be one of the last things they do. That's very cheap entertainment. And today, with their growth growing 20%, 300 million global users, I think it's an excellent place to be hiding out to a degree at this point.